Welcome, focused learners, to another explainer. Today, we are tackling a truly massive subject. We're talking about something that actively shapes the material reality of almost everyone on planet Earth, literally down to the value of the money sitting in your pocket right at this very second. We are going to examine the fascinating story of how an institution, one that was originally designed with a very simple, very domestic goal of just stopping American bank runs, quietly evolved into an absolute global superpower. We're talking, of course, about the Federal Reserve. It's an incredible journey, so get comfortable. Okay, let's dive into this because it is a deeply fascinating paradox when you really stop and think about it. When we usually think of global power, what pops into our heads? Right. We picture massive militaries, we picture those untouchable tech giants, or we picture heads of state making deals behind closed doors. But what if the single most powerful institution on the entire planet wasn't a government at all? What if it's a bank? An institution that operates, for the most part, entirely in the background, out of the daily headlines, yet wields this immense, unseen power to literally dictate the fortunes of entire nations. Well, today, we are decoding the mechanics of that hidden hand.
Here is our roadmap for today's explainer. First up, the accidental empire. Number 2, the rise of the fiat dollar. 3, tools of global influence. Moving on to 4, the Volcker shock effect. 5, domestic power and inequality. And we'll wrap it all up with number 6, the accountability question.
Section 1, the accidental empire. From panic to power.
To truly understand the Fed as it exists today, you absolutely must realize one key thing. It was never, ever built for global dominance. Not even close. It was forged out of sheer, unadulterated panic. So let's cast our minds back for a minute to the year 1907. At the time, the U.S. economy was booming, right? But the underlying financial plumbing, it was incredibly fragile. Just a house of cards. And all it took was one failed attempt by some speculators to corner a copper stock, and boom, it sparked a brutal, sprawling financial crisis. Terrified everyday Americans rushed to pull their savings out of the banks, which created this terrifying domino effect of bank runs across the country. And the government? They were basically powerless to stop it. The whole system was ultimately saved not by politicians, but by a private citizen, the aging titan of finance J.P. Morgan. He literally, and I mean literally, locked the presidents of New York's biggest banks inside his personal library and flat out refused to let them leave until they agreed to pool their money and bail out the economy. Now, it worked, but this terrifying reliance on just one unelected billionaire sparked years of fierce, heated debate. People realized, hey, we can't just rely on a wealthy guy's library to save us next time. This finally resulted in the 1913 Federal Reserve Act. It was a compromise that created a hybrid central bank. Its initial goal? Super simple. Just provide a safe, elastic currency and, whatever you do, stop another 1907 from ever happening again.
Section 2, rise of the fiat dollar. Breaking the golden fetters.
So for decades after it was created, the Fed kept its head down and focused purely on its domestic homework. But then the world changed. After 2 devastating world wars absolutely shattered Europe, the United States emerged standing tall as the undisputed economic heavyweight champion of the world. In 1944, at a conference in Bretton Woods, the entire global economic order was completely redesigned, and they put the US dollar right at the very center. The dollar was officially pegged to gold at exactly $35 an ounce, and other currencies were pegged to the dollar. Practically overnight, the Fed became the ultimate gatekeeper of the world's money. But fast forward to the late 1960s, the U.S. is fighting the incredibly expensive Vietnam War, and to fund it, they start printing way more dollars than they actually have gold in the vaults to back up. Other countries look at this, they get understandably nervous, and they start demanding their physical gold back in exchange for those paper dollars. The vaults were draining fast. So in 1971, President Nixon had to make a really drastic historic choice. He went on national television and officially, unilaterally broke the dollar's link to gold. It became known as the infamous Nixon Shock, and it completely changed the global financial system forever.
Now, you might think cutting the dollar off from gold would destroy it, right? But paradoxically, this crisis didn't destroy the dollar at all. It actually birthed its true empire. The dollar officially became what we call a fiat currency. That means it's money whose value is backed by, well, absolutely nothing physical. No gold, no silver. It is backed purely by faith in the U.S. government and the Federal Reserve. But to make sure the rest of the world actually kept that faith and still demanded those dollars, the U.S. made a frankly brilliant strategic pivot in the 1970s, the birth of the petrodollar. Through very careful arrangements with Saudi Arabia and the OPEC nations, they agreed that global oil would be priced and traded exclusively in U.S. dollars. Think about the sheer scale of that. Since literally every nation on Earth needs oil to keep their lights on and their economies running, every nation suddenly and permanently needed a massive, endless supply of US dollars. So suddenly, freed from the strict fetters of the gold standard, the Fed's little domestic mandate was permanently welded to the entire global financial system.
Section 3. Tools of Global Influence. The Mechanics of Power.
And this brilliantly illustrates the big question. How does a bank sitting in Washington, D.C., without a single soldier or a standing army, wield such incredible, unquestioned global power? Well, it operates quietly right through the hidden plumbing of the global financial system, using three primary weapons. Number 1, control of the reserve currency. Number 2, interest rate dominance. And number 3, dollar swap lines. Let's unpack these.
First up, the reserve currency. As we just discussed, the vast majority of global trade is settled in dollars. Because the whole world constantly needs them, foreign governments and investors are heavily incentivized to take their extra cash and buy U.S. Treasury bonds. Basically, they park their savings in America. Now, as a former French finance minister famously complained decades ago, this gives the U.S. an exorbitant privilege. Why? Because it allows the United States government to borrow money incredibly cheaply. There is always a buyer for U.S. debt. This cheap borrowing ultimately keeps American taxes lower than they otherwise would be, it easily funds huge domestic programs, and it lets the U.S. run massive trade deficits year after year without breaking a sweat. It's like having a credit card where the rest of the world eagerly pays your interest. Second, we have interest rate dominance. This one is huge. When the Fed decides to raise its interest rates to fight off domestic U.S. inflation, global capital suddenly floods into the U.S. seeking those higher, safer returns. But for other countries, particularly emerging economies, this is absolutely brutal. Because all that money is leaving their shores to go to America, their local currencies weaken rapidly, which makes importing basic goods painfully expensive. So central banks worldwide are very often forced to completely follow the Fed's lead and hike their own rates, even if their local economies are weak and absolutely shouldn't be tightening. The Fed leads, the world follows.
Finally, the third tool in the arsenal, dollar swap lines. Now, during a massive panic like the 2008 financial crash, global banks suddenly found themselves desperate for US dollars just to survive the night. But the markets had completely frozen solid. Nobody was lending. In that terrifying moment, the Fed stepped in as the world's ultimate emergency lender. Here's how it works. The Fed literally creates emergency dollars out of thin air. They then lend those dollars to a foreign central bank, say the European Central Bank. Then that foreign central bank lends those dollars out to their local banks to unfreeze the system and keep the lights on. But, and this is a massive but, here is the critical geopolitical catch. The Fed gets to exclusively decide who receives a swap line. It's a VIP club. During crises, Europe, Japan, Brazil, and Mexico got them. They were saved. Many other nations did not. They were left out in the cold. Access to emergency dollars is a privilege. It is absolutely not a right. And that dynamic gives the United States quiet, unbelievable leverage over the financial stability and, honestly, the sovereignty of other nations.
Section 4. The Volcker Shock Effect. Making and breaking nations.
Now, to really understand that these tools aren't just abstract whiteboard economic theories, we need to look at a real-world historical case study of how this impacts actual human lives. Back in the late 1970s, the U.S. economy was drowning in something called stagflation. That's a miserable combo of stagnant economic growth and runaway sky-high prices. Things were bad. By 1979, a new Fed chairman, Paul Volcker, was appointed with one single laser-focused mission: kill inflation at any cost. His chosen method? Pure, unadulterated shock therapy. By 1981, Volcker aggressively, relentlessly used the Fed's power to push the main interest rate to a staggering 20%. Just pause and imagine that for a second, trying to get a mortgage or a car loan with a 20% interest rate. The impact of this move was basically a tale of two entirely different worlds. In the United States, that bitter medicine caused a really painful, deep recession. People lost jobs. But it actually worked. By the mid-1980s, inflation was dead, the economy rebounded, and Volcker was widely hailed as a domestic hero. But if we pan the camera down to Latin America, the Volcker shock was nothing short of a catastrophe. Here's why. Throughout the 1970s, countries like Mexico had borrowed billions and billions in dollar-denominated loans, and those loans had floating interest rates. So when Volcker suddenly hiked U.S. rates to 20%, the interest payments for those Latin American countries absolutely skyrocketed overnight. They literally couldn't afford to pay back the debt.
Entire countries went virtually bankrupt. They were forced into brutal, strict austerity measures by international lenders. Poverty exploded, triggering what historians now call Latin America's lost decade. It is a stark, sobering reminder. A policy designed entirely by Americans to solve a purely domestic American problem can effortlessly unleash devastation across an entire neighboring continent. That is the reality of the Fed's reach.
Section 5. Domestic Power and Inequality. The Unspoken Consequence.
So the crucial point is that the Fed's immense global footprint is really just an extension of its incredible sweeping power right at home. To truly grasp its modern domestic impact, we have to look at a radical, previously untested tool that the Fed pulled out after the 2008 financial collapse. It's called quantitative easing, or QE for short. You've probably heard the term, but let's demystify it. Back in 2008, dropping interest rates all the way to zero simply wasn't enough to stop the economy from sliding into a total depression. They needed a bigger bazooka. So the Fed essentially created trillions with a T, trillions of new dollars out of thin air, officially acting as central bank reserves. And what do they do with that new money? They went out and bought up massive amounts of assets, primarily U.S. government bonds and mortgage-backed securities, right out of the banking system. The goal was to flood the entire economy with liquidity, to make sure banks had cash and the financial gears kept turning.
Now, as you can imagine, injecting trillions of dollars into the economy created a fierce, ongoing debate. On one side of the aisle, defenders fiercely argue that QE was the ultimate necessary rescue. In their eyes, it successfully stabilized the banking sector and literally prevented a second Great Depression. And the data shows it did stop the collapse. But on the flip side, critics point to a very profound, undeniable side effect. By keeping interest rates near zero for years and pumping trillions of dollars into the financial system, the Fed inadvertently created a historic, unprecedented boom in asset prices. The stock market, like the S&P 500, absolutely quadrupled. Housing prices went through the roof. Now, who benefits most from soaring asset prices? The people who already own them, which is largely the wealthy. Meanwhile, real wage growth for average working families largely stagnated over that same period. So critics powerfully argue that in the process of saving the financial system, the Fed essentially engineered a massive upward transfer of wealth, creating this lingering public perception that the central bank exists mostly to rescue Wall Street whenever the markets start to wobble.
Section 6. The Accountability Question. A Crisis of Legitimacy.
Let's move to and see how this builds to a really critical tension. All of this immense power, both domestic and global, brings us straight to a modern crisis of legitimacy. Think about it. The Federal Reserve is undoubtedly one of the most powerful governing bodies on planet Earth, and yet its key decision-makers, the Board of Governors, are appointed by the president, not directly elected by the public. Defenders of this system strongly argue that this technocratic independence is actually the Fed's greatest strength. They argue that by shielding the bank from everyday politics, the Fed can make those tough, painful, long-term economic decisions like Volcker hiking rates to 20% without buckling to the immense pressure of the next election cycle. If politicians controlled the money printer directly, the fear is they just print endless money to win votes, leading to hyperinflation. But on the other hand, critics argue this independence is slowly mutated into a dangerous lack of democratic accountability. The question they pose is this: is it acceptable for an unelected, highly insulated body to hold the absolute power to create trillions of dollars out of thin air, inadvertently pick economic winners and losers, and dictate financial conditions for billions of people globally, all without direct voter oversight?
And that, focused learners, brings us to the end of our explainer. We started our journey looking at a relatively modest institution, one created merely to act as a simple fire department for jittery American banks way back in 1913. And we've watched it systematically acquire the tools of a literal global empire. It's a complex story filled with good intentions, domestic solutions that accidentally transform into massive global problems, and the quiet, steady accumulation of staggering financial power. Which leaves us with this final, genuinely unsettling thought to take away and chew on. In a modern world where a single, unelected bank operating in the background holds this much overwhelming power to shape our everyday material reality, who truly holds them accountable? Thank you so much for joining me today. Keep asking those big questions, keep digging into how the world really works, and we'll see you in the next explainer.